Rising interest rates, lingering inflation, they're all taking a toll on the economy. New data is showing that recent economic growth is nearly 2% less than predicted. Despite the sluggish growth, consumer spending is up, with more shoppers looking to spend money. So today we've got three experts with us to help navigate your spending and your saving. Janae Adams with Debt Sucks University, Nathan Grant with MoneyTips.com, and Michelle Shanks with Summit Credit Union. They're here to answer your financial related questions live. Here's how you get your questions to our experts. You text us that question, 336-379-5775. Now, each one of our experts has specific expertise, but there's a whole lot of financial overlap here. So, Michelle, let's start with you first. Let's start with talking about financial deserts. What does that term even mean?
Financial deserts is, in a nutshell, any place or region where folks have difficulty or challenges getting access to financial resources, whether it is a brick and mortar bank or credit union, or the technological aspect of not having the ability to download an app or to get on a computer to get what they need financially.
Right, and we're seeing a little bit more of that on an uptick since a lot of banks are kind of closing their doors and they're going online instead. So that's the issue there, yes?
Yes, definitely. Since I'll say about 3.5 years ago, especially since the pandemic, we've seen a lot of financial institutions closing down local branches. So, especially anyone in rural areas, they may not be able to gain access to a physical branch location as easily as they used to. And some folks here in North Carolina are driving anywhere from 50 to 100 miles just to get in front of an actual person at a financial institution.
Yeah, and that's hard for a lot of us to kind of even wrap our heads around because there's so many of us that live in cities that we're not thinking about that. And so we need to be taking a look at those financial deserts, what we do about those. Okay, let's talk about another financial issue that we have been hearing a whole lot about lately, and that is the possibility of recession. So, Janae, we keep hearing about it. It hasn't quite happened as of yet, and yet all the experts are saying we need to plan for it.
And definitely that's true. We have been waiting on it, but they are predicting that it'll be towards the end of this year. The thing that I was saying that people need to prepare for is because every single day I am seeing news segment after news segment about layoffs, and they're not hundreds of layoffs, they're thousands of layoffs, from 7,000 here, 8,000 there. And so people just need to think about the industries they're in. And if you think that is something that may have a job layoff in the future before the end of the year, start preparing your finances to take that hit.
And when you say start preparing your finances, what is like maybe step 1 and 2 so that we can at least get our minds wrapped around that?
Definitely. So step one is to look at what your expenses are each month down to the penny and get that number down on paper. Step two is to get you an emergency fund of at least 3 to 6 months, if not a year, so that if you do get laid off, you're not looking desperate in the interview.
Okay. All right. All right, Nathan, let's kind of shift to some financial literacy. This happens to be Financial Literacy Month in the month of April. And you say that there's a lot of things that people think they know, but they don't know, especially when it comes to credit scores and credit reports.
Yeah, even though it's Financial Literacy Month, these are all things that year round we might take for granted and think we know what something means. And even if you're off a little bit with some of these definitions, you kind of want to know what the right thing to do is, so that way you're making the best decisions with your money. So one of the common things we always see is there's credit reports, there's credit scores. We talk about them a lot, and we try to manage them a lot. But what really are they? Well, one is not the same as the other. Credit reports are tied to your social security number, and it contains financial information that details how you've managed your credit in the past. And this is reported voluntarily by lenders to the credit bureaus. The major ones are Experian, Equifax, and TransUnion. And each credit report may contain slightly different specifics because of that. Now, your credit scores, that's a number that measures how trustworthy you are. It's called your credit worthiness. And if you're going to be borrowing money, they need some metric to determine how trustworthy of a borrower you are. And your credit score is based on information from your credit report. So that's good information, but it could be things like late fees and stuff that gets sent to collections if you have unpaid medical debt. Those things can last on there for a long time. So you really want to be able to know the difference between the two, so that way you can tackle them and hopefully increase your credit score along the way.
Okay, and so you can look at your credit reports for free.
Yeah, it used to be, so first of all, a lot of your like banking apps and portals, they might have credit monitoring included, but even if not, there was always annualcreditreport.com let you once a year for free check your credit reports. But since the pandemic, they made that information available weekly, that you can get those reports. And they still, I checked just this week, they still are up to date with that, where weekly you can get a check. So there's lots of options of where you can check your credit reports, but that's just some of the common ones that you can look into.
Okay, and credit scores are a big deal because they can really impact all kinds of things. So Janae, let's talk about that, how credit scores impact all kinds of things.
Yeah, so the latest about credit scores and its impact, and it's actually become misinformation, has been around mortgage rates. And so everybody around social media is saying Biden is raising your mortgage rates because you have great credit. But that's not true. What that has to do with is with the FHA. And that is a government-backed mortgage. And guess what? Only 10% of mortgages in the country are FHA. So the other 90% of you all mortgages are not going to be affected by this at all. So definitely when you see things on social media from social media experts, don't worry about it at all.
Don't worry about the whole mortgage rate and the credit score thing.
Yes.
Okay. All right. So, Michelle, I think one of the big things that people ask all the time is about overdraft protection. And there are some pros and there are some cons with overdraft protection. So let's kind of talk about that.
All right. Well, overdraft protection is basically something set aside in case of an emergency, or if your checking account overdrafts or overdraws. It could be you have a savings account linked to it. It could be that you have your credit card linked to it, or the financial institution that you deal with may have a sort of a buffer, so that if you overdraft, they will go ahead and take care of it and you just repay that financial institution back. I will tell you that last one does come with a cost. So if you are able to secure funds on your own, have a little rainy day fund set aside that may be linked to your checking account, or some other resource, so that if you happen to overdraw in your account, you are basically using your own money to do that. Feel free. That is a great option. But those fees can really add up. They could be anywhere from $32 to $35, and in some places it may be a few dollars more. So if you think that that might be something that you would be concerned about, find a way to give yourself some relief. Put away maybe $5 or $10 or more in a separate account that could be linked to your checking, in case there are overdrafts, so that you are not being charged for that, because there could be a double cost, one from the financial institution and then one from any merchant that you did an overdraft with. So you could get hit twice.
All right. Yep. Sounds good. Okay. Because, yeah, you don't want to be paying all those different times and then look at your bank account 2 days later and realize like you're in a lot of trouble. All right. We're going to be taking your text questions when we come back.